Just a few short years ago, the future looked incredibly bright for electric vehicle startups. Investors were throwing money at these companies, expecting the EV market to explode as environmental concerns drove demand for green transportation alternatives. However, the situation has taken a dramatic turn. Most of these startups are now fighting for survival. Even tech giants like Apple, which at one point were working on developing an Apple-branded electric car, have abandoned their automotive ambitions. According to an analysis by the Wall Street Journal, out of 43 EV and battery companies that went public between 2020 and 2022, a staggering 5 have already filed for bankruptcy or been acquired. An additional 18 companies are currently on the brink of bankruptcy. This dire situation has raised critical questions. Why are so many EV startups running out of cash and going out of business? What challenges prevent them from competing effectively against established players like Tesla and BYD? And why has demand for EVs failed to meet the optimistic projections that fueled the initial investment frenzy? There's no doubt that electric vehicles are rapidly gaining in popularity and consumer acceptance. Driving ranges have improved, charging times are getting faster, and EVs now offer performance that can rival high-end gasoline vehicles. EVs are increasingly seen as a sustainable and practical transportation solution as the world transitions towards renewable energy. However, despite the surging consumer demand, most of the companies manufacturing EVs are struggling significantly to achieve profitability and sustain their business long-term. Many are burdened by heavy debt loads taken on to fund expensive manufacturing expansions and vehicle development programs. One of the biggest reasons EV startups are failing is the astronomical amount of capital required upfront to bring an electric vehicle to market. Unlike established automakers with existing factories and supply chains, EV startups have to build their manufacturing operations from scratch. They must invest billions into constructing automated assembly plants equipped with specialized tooling. On top of the factory costs, they need hundreds of millions more to fund component supply chains, technical engineering, and product development, and build out sales and service networks. Estimates suggest an EV startup needs a minimum of $500 million just to build its first factory. Then it needs another $200 to $500 million for supplier costs, plus $250 to $500 million more for product development and engineering. Once the factory is finally up and running, it must produce huge numbers of vehicles just to cover the exorbitant fixed costs. Not to mention the continuous capital required to fund growth, new model launches, and staying ahead of the technology curve. In the early heydays, investors were willing to pour in vast sums on the promise of future profits as EV demand supposedly went through the roof. But now the capital sources have dried up. Many are stuck halfway through their business plans without a path to self-funding. The financial projections and business plans that many EV startups used to attract investors were predicated on extremely optimistic assumptions about future demand for electric vehicles. Startup management teams and Wall Street analysts were projecting demand curves that showed exponential growth and eventual mass adoption by consumers globally. They cited multiple drivers like government incentives, emission regulations, rapidly falling battery costs, and an increasing awareness of climate change that would compel people to ditch internal combustion vehicles for EVs. This surging demand, the logic followed, would enable EV companies to rapidly scale production and sales to achieve economies of scale and profitability. However, the reality has played out quite differently so far. While EV sales have been growing steadily year over year, the pace of adoption has been more linear than exponential. Demand has failed to meet the wildly optimistic forecasts set just a few years prior. For example, in 2021, research firm LMC Automotive projected that EV sales in the US would hit 1.9 million units by 2023. The actual number for 2023 is projected to be around 1.1 million, a sizable 42% shortfall compared to expectations. Similar gaps between forecasts and reality exist in other major auto markets like Europe and China. There are multiple factors constraining more rapid EV adoption and keeping demand from skyrocketing as projected. First off, battery costs have not fallen as quickly as anticipated, keeping EV sticker prices elevated compared to gasoline counterparts. Government incentives have helped, but not fully offset the premium pricing. Additionally, public charging infrastructure build-out has lagged, leaving prospective EV buyers worried about ridiculous range anxiety. While fast chargers are becoming mainstream, coverage is still limited in many regions compared to gas stations for conventional cars. Lingering concerns also persist around battery longevity, residual values, recycling and disposal issues, and grid capacity to handle millions of EVs charging simultaneously. Until these issues are completely resolved, mainstream consumer demand will remain tempered. For startups that raised funds based on pie-in-the-sky demand forecasts, the shortfall in sales has created a liquidity crunch. With capital sources drying up amidst a broader investor pullback, many don't have the funds to survive until demand hopefully catches up with expectations down the road. Most of these startups are also not established enough to compete with the larger companies, such as Tesla, BYD, Ford, and Volkswagen, which have huge economies of scale due to their extensive supply chains and distribution networks that allow them to build electric vehicles at a lower cost per unit than these emerging companies. That makes it difficult for startups to compete on price, which affects their ability to grow and expand their consumer base and business. The Chinese company BYD and America's Tesla have established themselves as the leaders in the electric vehicle market and have already made large profits, which has allowed them to reduce manufacturing costs without reducing quality. In contrast, most electric vehicle startups have problems with brand recognition and market penetration. So they need to innovate and present a different proposition to differentiate themselves from the competition. But at the same time, it's more risky that something new or very different from what's already been tried and tested will not work. The dilemma is that if you innovate less and adopt more traditional methods or designs, there will be less reason for people to be interested in your product, at least for companies with little brand recognition. The gap between projected and actual demand for electric vehicles has proven challenging for many EV startups to overcome. Reputable forecast firms like Bloomberg New Energy Finance had extremely optimistic outlooks just a few years ago. For example, in 2021, BNEF forecast that sales of fully electric and plug-in hybrid vehicles in the United States would reach 1.7 million units in 2023. However, the latest estimates peg 2023 US EV sales at only around 1.46 million units, undershooting BNEF's prediction by around 15%. While this doesn't mean the EV market won't continue growing robustly in the years ahead, it does illustrate how even the most prestigious analysts misjudge the pace of adoption in the near term. Globally, EV sales are indeed rising rapidly, but from a relatively small base, still below 10% market share in most countries. In the US specifically, EVs accounted for only around 8% of total new vehicle sales in 2023, according to Edmunds data. This is well below projections from just a couple of years ago that had EV share pushing towards 15% by 2023. So while directionally the transition to EVs is underway, the velocity has underwhelmed relative to the rosy projections that propelled investor excitement and capital raising for EV startups in the 2020-2022 timeframe. Companies that base their business plans and funding needs on EV demand outpacing reality have found themselves in a liquidity vice. With demand not living up to forecasts, they're generating less revenue than anticipated from vehicle sales. At the same time, their high fixed costs for manufacturing, R&D, marketing, and operations persist. This cash burn has quickly depleted their funds, especially as capital sources have dried up with investor sentiment turning bearish on EVs. Unless demand accelerates rapidly in the coming years, it appears many of the EV startups that proliferated during the recent boom times won't survive. They simply don't have the financial resources or established revenue streams to survive an adoption cycle playing out more gradually than predicted. Another factor contributing to the disconnect between projected and actual demand for EVs is the uneven pace of adoption across different countries and regions. While markets like China, Europe, and certain US states have seen relatively rapid EV uptake, others are lagging far behind. In China, the world's largest auto market, EVs represented around 27% of total new vehicle sales in 2023, according to data from CAM. This is being driven by aggressive policy incentives, investments in charging infrastructure, and a robust domestic EV manufacturing base led by companies like BYD and NIO. Similarly, in Europe, registration data shows electric vehicles reached around 20% market share across EU nations last year. Government mandates like the EU's plan to phase out new petrol and diesel vehicle sales by 2035 are accelerating the transition. However, the picture is quite different in the US, where EV adoption continues to progress at a more sluggish pace outside of EV-friendly markets like California. Despite federal tax credits aimed at boosting sales, nationwide EV market share was around only 8% in 2023. And in many emerging economies across Africa, Latin America, and parts of Asia, EV penetration remains at just 1 to 2%, or even lower due to premium pricing, lack of charging networks, and weaker policy support compared to China and the EU. This patchwork of uneven policies, incentives, and infrastructure creates challenges for EV manufacturers looking to accelerate global sales volumes. Companies cannot rely on a unified worldwide market and must tailor products and strategies region by region. It also impacts total demand when major markets like the US are not experiencing EV sales momentum at the same velocity as trendsetters like Europe and China. This misalignment of demand across countries has been another factor leading to EV startups missing their targets. Many of these companies forecasted sales based on an assumption of a globally coordinated EV transition occurring in lockstep across all major markets. but with some regions racing ahead while others move slowly, it has capped the total obtainable market in these pivotal early years of EVs. If you enjoyed this video, make sure you hit that like button and subscribe to this channel for more amazing videos.